it's hard for me to think we're definitely about to enter a nasty recession. And more to the point, if the bond market's rallying because it's worried about growth, why are small cap stocks ripping to the upside? Like, that doesn't make sense.
The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. It is only intended to provide education about the financial industry. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this program is no guarantee of future results. Any indices referenced for comparison are unmanaged and cannot be invested into directly. Any references to performance of securities are thought to be materially accurate and actual performance may differ. As always, please remember investing involves risk.
Welcome back to another edition of the Daily Dots here on Wednesday, August the 13th. I'm coming to you about 25 minutes before the bell. So I'm going to go through a few things and then kind of wrap up with the market. It'll be a little closer to the close for you. This will be a really quick one, and it's going to be me flying solo. Just have a couple things I want to touch on, and then I'll hit markets. The biggest thing is when I got to work today, I think we're like 99, 100% chance of getting a rate cut at next month's meeting. Now we're 111% price, which means there's an 11% chance that we do 50 basis points. So you're currently at about pricing 28 basis points worth of, this is live, by the way, 28 basis points worth of cuts. So you're seeing people make bets for a 50 basis point cut. The Treasury Secretary all but literally called for that today, and said we needed 150 to 175 basis points of cuts. You have over 5 cuts priced for the next calendar year from this point. So we got to the point where markets, and it seems like policymakers, at least outside the Fed, all calling for a giant rate cutting cycle and perhaps a bonus, 50 basis point cut right now. Interesting is, as I outlined in great detail yesterday, interesting is we have not only high inflation, but re-accelerating inflation that I fully anticipate to keep getting worse. Now, the market tends to disagree with that, which I'll talk about a little bit, but I'm at a bit of a loss when it comes to that. Unless, you have one of two views, this whole thing kind of makes sense. One, jobs really are falling out of bed. It's going to get worse. Now, if you ask the president, the jobs are fine, and the BLS just cooked the books to make them look bad. So either that's true and we shouldn't cut at all, or that isn't true. The data was legit. The economy is starting to fall, and we should be cutting to avoid a recession. That's possible. And what I'm seeing in the bond market, both front end and more especially to me, the long end, you're seeing rates come down a good bit, pricing in, like I said, 5 cuts in the next year, 5+. And if you look at inflation swaps, break even, stuff that prices inflation out into the future, that stuff's all saying like, hey, inflation is going to be fine. It's going to be lower than we expected a few weeks ago. So the market really took this, in my opinion, warm CPI print and has decided that inflation is just nothing worth worrying about, but maybe that growth is. And the other sort of thing I'll throw out there as a thought experiment, I don't really think this, but well, let me set the stage here. I think cutting rates would actually lower inflation and lower growth. Now, obviously, the economists, the textbooks will tell you the opposite. And I think the opposite is clearly true whenever you don't have a giant debt load and you don't have a giant deficit. But when you do, I think you remove so much interest income from the market that you actually kind of tighten things up. So that's my view. If we do lower rates, you're going to hurt growth and inflation. And if you hurt growth and inflation, that's good for the bond market. So in that sense, it actually does make sense for the market to do that. The problem is the market doesn't think that. I think that I don't think the market thinks that. I don't think the market essentially believes in these MMT cornerstones of higher rates being actually inflationary and lower rates being more disinflationary. So I don't think that's why the market's doing it. I think the market's just doing it because it literally thinks inflation not a problem and growth is. I think it might be right about growth being a problem, although I'm not fully convinced. Yes, the jobs revisions are bad. The labor market is clearly teetering on something ugly, but it doesn't mean it has to fall over that cliff. Um, with the 7% deficit, with strong household balance sheets, with wages firming up, like there's plenty of reasons for the economy to hang in there and kind of muddle through at 1% growth. Doesn't mean it has to. You could fall into a recession, no problem. Like we see plenty of signs that we could be leaning that way, but it's hard for me to think we're definitely about to enter a nasty recession. And more to the point, if the bond market's rallying because it's worried about growth, why are small cap stocks ripping to the upside? Like that doesn't make sense unless you think lower rates are better for the stock market than having earnings contract because of the recession. To me, that would be crazy, especially for small caps. But maybe I'm just not seeing it clearly, and maybe the market's right. That's the way it goes. But as I mentioned yesterday, I haven't felt this detached from the market on something in quite a while, where I feel like I'm taking crazy pills watching the price action, specifically in the long bond, because to me, what policymakers in the market are kind of suggesting right now is, well, we're just going to cut into high and accelerating inflation. To me, that suggests you are tempting fate, at least from the market's point of view, on inflation. But clearly the market thought this last print was fine, which puts a lot more emphasis on future prints. It puts some emphasis on tomorrow's PPI. I think yesterday I said PPI was today because it normally is the day after CPI. So in my head, I had that wrong. So we'll have to see how this goes, but I'm confused on bond market rallying, stocks ripping on high inflation and turbo cuts. And I don't know why. I don't know why we would get 5 cuts in a year unless we fall into recession. And if we fall into recession, I don't know why equities would be doing what they're doing, especially small caps, which are very, very economically sensitive. Yes, lowering rates would be good for them, but other than that, they already have an earnings problem that would just get worse.
The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. Any references to performance of securities are thought to be materially accurate, and actual performance may differ.
2 other things I want to talk about. One, I mentioned that this export tax was essentially what we're talking about, with NVIDIA, AMD having to pay 15% to the government for everything they export to China. Clearly unconstitutional. Now, may they find a new way to label that and distinguish it, or maybe no one sues, so no court's able to say this is unconstitutional. But clearly it is if you just read the Constitution. So I found it interesting that today Scott Bessent basically came out and said, hey, that's a good model. Like we might use that model for more stuff. Interesting for 2 reasons, other than the legal stuff, which obviously no one's going to care about. But interesting that, like, I don't know. I thought we were trying to fix the trade balance. Like we want to lower the trade deficit. So we put a tax on imports. Now we're talking about turning around and putting in a tax on exports. Like why? Why are we just going to tax trade going in every direction? And why do we think that would be good for, well, anything? I don't know. Just interesting. I look forward to seeing how that develops, if that really does catch on. And is it just going to be like the whim of the executive on who pays the tax and at what level, and what to do with that money? Is Congress just have nothing to do with any of this anymore? Like, and are they okay with that? And if so, why? And where are the court's going to land on it? All interesting things. And if not, if this is just like hey, the president gets to decide all tax levels on his own, on imports, exports, which countries, which firms, down to that level, then investing is going to change forever, because it's going to be all, the whims of the Oval Office and not necessarily like, kind of what we think of as trade, as taxes, as capital allocation. So definitely something to keep an eye on. Some people may find it boring to keep an eye on legal things like that, but that's just getting too important if this is actually going to be a trend. And another thing was the Bureau of Labor Statistics, who have clearly been in the headlines lately. They announced in the CPI yesterday that they are pulling long-term care insurance from next month, and I guess I'm assuming, and after that, inflation from that, and that has been running hot. So to see them pull pull, something that has been running hot, like for me, that may be fine. Like they may have a great reason for that. When you dig into the minutia of the way you collect inflation data, like there's a lot of stuff that can look sketchy on the outside that ends up being totally normal, totally makes sense. I'm sure there are times they pull stuff out that is actually deflationary, not inflationary. So I'm not saying like they're doing anything sketchy with this, but to me, like I tried really hard to find an explanation for that, and all there was they said something about like market conditions or something like that. They just threw some like cliche at it instead of giving you a real answer to why they were doing it, and I find that a little distressing. And now I feel like I've started looking at these reports every month to see what stuff they're pulling out, because if every month they just keep pulling out another thing that is a high print, like without explaining it other than throwing some word salad at us, like it becomes a little unnerving that we really are going to start suppressing bad data, which has medium long term significant consequences, especially for global capital that we absolutely rely on, not just for our markets to go up, but for to fund a lot of the things we do. We are a massive debtor country that requires significant capital injections from the rest of the world. So to mess in any way with the integrity of the data that we show the rest of the world would be a dangerous situation, to say the least. And that's all I have on all that stuff. The last thing I'll say, or last thing I'll do, is kind of run through the markets real quick. And as I do that, we have 14 minutes to go to the close. S&P up 0.2, Q's down just a tiny bit, down 0.07. You have another massive move higher for small caps, up almost 2% after a really big day yesterday. So small caps are up like 4% in 2 days or more. Equal weight also don't having a good day. You're getting a bit of a rotation. You have Mag 7 down 0.36, equal weight up 1.37. So a nice rotation out of the top into equal weight and into small caps. These tend to not last, of course, but interesting that we're getting a big one here. Probably on just about, the rates flying down because, we have the currently 107% chance of a rate cut next month. All world ex-US up 0.6, so outperforming the US today. And that's because the dollar's down another 0.21. Oil's down 0.6. Bitcoin's up about 2%. You have gold up 0.2. Silver up 1.4. The rest of the metal's pretty flat. Copper down a little bit. Back to rates, the thing that has me scratching my head until it bleeds. 2-year down 5 basis points. Same with the 10, same with the 30. So the whole curve's just kind of down 5 bips today. Something I am not going to attempt to explain. Apple's up about 2% as they announce a bunch of AI stuff. None of that was particularly impressive to me. They're going to make like a little tabletop robot that does Siri, and they're going to do like security cameras and a speaker. Like, okay, like 2018 called. They want their products back. Let's see. Vol. I'll use spot VIX today. It's just under 15 because front month VIX jumped up because the contract rolled. So now you're at back above 18 on front month vol, and that curve from there out the rest of the year is a lot flatter now after we collapsed on the expiration of the last contract. One thing I will note on vol is that the vol of vol, the VVIX, the volatility of volatility, which sometimes can kind of front run actual vol. It's up 4% today. It's not like it's super high or anything. It's not 4%. It's not even like a giant move for vol, but I don't know. It felt like somewhat notable to me that it's back above the 50-day and kind of at least threatening to threaten, I'll call it. And if that starts to rip to the upside and vol's kind of flat, like that would be notable to me moving forward. But that is all I have for today. We'll be back with you again tomorrow. Don't forget you can download and subscribe at knowyourriskpodcast.com. Go check us out on YouTube if you want to see my face instead of just hear me. I would not recommend, but it's always an option. And check us out everywhere on social media. But we'll be back with more tomorrow, and we actually will have the PPI tomorrow and a few other things. So yeah, check us out tomorrow. Cheers.
Investment advice cannot be given without a client service agreement. Zach Abraham is an investment advisor representative of Trek Financial, an SEC-registered investment advisor. Bulwark Capital Management is a marketing name only and does not carry a separate registration.